To First Trades right here on Nifty now, and let's welcome on board Harsha Upadhyaya, CIO of Equity Quote AMC, joining us on the show right now. Hi Harsha, morning. Good to be speaking with you. And firstly, the earnings season is in full swing, and we are seeing great moves in select counters. But help us analyze how are you looking at the numbers, and where are you getting to see the surprises, and what's your overall take?
Good morning, Srishti. As far as earnings season is concerned, this is going to be more of a subdued kind of a season as far as headline earnings growth is concerned. However, there are certain segments of the market which are delivering good set of numbers. I think that's where incremental money would probably move in. If you look at sector-wise, I think cement has done well and is likely to continue doing well. We have seen quick commerce numbers coming in very strongly. That's another subsegment where things are fine. We also believe that there are certain pockets of industrials and defense where the numbers are going to be quite strong. So rather than taking a sectoral top-down view on the market, I think it's prudent to take stock-specific bets depending on where the valuations are, where the earnings are expected to go, etc.
Okay. Hi Harsha, morning. This is Nehi also joining in the conversation. We last interacted you on 9th July, which was the so-called tariff deadline back then. What's your take on the next tariff deadline that's just around the corner? We have no concrete announcement so far. How do you think and that could impact the markets back home? And if at all you are making any changes to your portfolio, how are you cushioning from this impact?
It's been a moving goalpost, right? I mean, we have been seeing some of these deadlines coming and going, and new deadlines coming in again. We still do not know for sure which way the tariffs are going to go. When is that finally going to come out in the public, etc. However, it's very clear that probably the relative impact on Indian exporters compared to some of our peers in the Southeast Asian market, Asian market, would be relatively less worse off. So to that extent, I think we should be fine. And also, if you look at our own portfolio, we have taken some prudent measures, not now, but many quarters earlier, just before the US elections, we kind of tilted our portfolios more towards domestic-oriented businesses, thinking that the domestic businesses have better resilience in terms of growth, and the valuations were also a lot more conducive at that point of time. Still that view continues, and we have not really increased our exposure to exporters in a big way, apart from chemicals, which we think has turned around in terms of the cycle itself. And also compared to China, our tariff rates are expected to be lower. So to that extent, it's unlikely that you will see big negatives from tariffs on that sector. But by and large, we will still wait for full clarity. Then only we'll probably look at adding more exporters in the portfolio.
But Harsha, since you did talk about, internalizing the entire investment process ever since the uncertainty really began, especially on tariffs, where within the domestic pool do you find comfort to add on to positions at these levels also? Because it seems like much of the positives are already in the price and the prices are expensive.
You're right, Aisha. That's why I started saying that probably top-down sectoral view at this point of time may not be the right way to construct your portfolios. And within every sector, you will see winners and losers as you go ahead, depending on how they deliver on earnings. However, there are certain segments within the domestic businesses where there seems to be reasonable amount of clarity in terms of earnings going forward. For example, telecom should be a good area in terms of how the earnings are going to pan out over the next couple of years. Aviation is another sector. We have seen similarly good numbers from cement, and we also expect it to continue delivering better numbers. As on the raw material side, there is a lot of positives, and also the volume growth, as per the commentary that we have seen from certain managements, seem to indicate that probably things are going to improve on the volume front. So overall, there is another segment. Within banking and financials, I think there are certain names which are doing well. And whatever the impact of repo rate cut on the names is also probably more or less behind us. So to that extent, I think things should be fine in this basket as well. And then there are several other sectors, maybe from a top-down perspective, you will not find too many great stories. However, there could be individual names which will still offer you a better growth compared to overall average market growth.
Very interesting take there, Harsha. When it comes to the chemical basket, you believe that the sector is poised for a turnaround. But since the sector is that large, help us understand that what exactly is looking interesting to you if someone really has to go deeper and study the stocks and the companies. What are you looking at? Because some experts do highlight that the sector is coming out after a lot of those inventory issues that were prevailing. Some companies are towards the fag end of their capex spending, and the pricing power seems to be coming back a bit. But what exactly are you liking?
Srishti, clearly within chemical segment, we continue to like specialty chemicals. I think that's where there is a competitive advantage on a relative basis, even in the global market for Indian manufacturers. And some of the companies have really delivered on the quality and on the innovation in terms of newer molecules, etc. We have also seen, as you rightly mentioned, inventory destocking in certain segments of specialty chemicals over the last 2 years. So the impact that it had on the volume growth as well as on the margins is possibly behind us. We are slowly seeing volume growth coming back and the expectations of better pricing as well in the markets as of now. I think when you are looking at the sector, you should be looking at specialty chemicals and also those names where the managements have continued to invest on capacity over the last couple of years. I think that's very, very important. If any management has continued to expand its capacity despite the cyclical downturn that we saw in the industry, that shows that the managements are confident in terms of the medium to long-term growth. And if they're already ready with the capacities, I think those are the names that you need to bet on as you go ahead.
Right. But Harsha, when you talk about banks, so far one has seen that clear distinction wherein the large private banks, your ICICI Bank and HDFC Bank seem to be winning the race right now. Do you go bottom up, take contra calls within banks, or stick with the leaders?
I think within banking, you need to be more bottom up at this point of time. There are certain banks which are delivering on growth as well as asset quality. There are certain other names which are finding some headwinds on either asset quality or on the growth. I think that's where you need to look at all of these factors and also keep valuation in mind. The banking and financial sector, while it has outperformed in the last 6 to 9 months, is no more very, very attractive in terms of valuations, right? I mean, we have seen some absolute performance as well as relative performance from this basket. So to that extent, I think we need to keep all of this in mind. And as we discussed in the earlier part of the show as well, this is unlikely to be a season where you will see too much of growth across segments, across businesses. So to that extent, you need to be careful in terms of what valuation you are paying for some of these names and how resilient would the earnings growth be as you go ahead.
But Harsha, when you say that you have tilted your portfolio to be more domestically focused right now, any take on the consumption basket? Because of late, the numbers, and especially the Q1 updates, have been fairly decent, and the market seems to be liking the fact that these companies are now talking about growth after a long period of almost nothing. Give us your sense on the consumption basket. Are you liking the space overall or not?
Clearly, macro tailwinds are there for consumption, right? And we need to see which of those baskets are likely to see tailwinds from tax cuts, inflation going down, EMI hit going down for consumers, etc. Within the overall consumption basket, we think that discretionary consumption will still continue to be better than staples. That's our view at this point of time until we see a full-fledged recovery from rural economy, which could be a couple of quarters away in our opinion. As far as discretionary consumption is concerned, I think you need to slightly look at some of the sectors which from an amphi-sectoral basis or from a market perception perspective may be classified into other sectors, but they are essentially consumer discretionary segments, such as hotels, travel, tourism, aviation, and even quick commerce, in our view, is likely to do well. I think these are some pockets of consumption which we are very, very positive on. As far as FMCG is concerned, we would probably wait for a little more clues in terms of how volume growth is likely to pick up. The valuations are not so cheap. While the stocks may not have done much in the last couple of years, even the earnings have not moved anywhere. So to that extent, the valuations have not really changed for this basket. So we would wait for a little more clarity on that side. And on the white goods and the other consumer discretionary, including auto, the volume growth seems to be a question mark at this point of time. So we would wait for probably lower levels to really look at them as we go ahead.
Okay, Harsha, great to chat with you this morning. Thanks so much for joining us and highlighting your view on a
Thank
whole
you.
bunch of sectors this morning. Thanks so much. Let's move away from that and once again focus on the